Welcome to our session today, Essentials of Startup Formation. This is hosted by Alliance of Angels and with our sponsor, K&L Gates. And we are very fortunate today to have Gary Kocher and Francisco Olmedo to join us and share their expertise on this topic with us. Before we go into the details, I'd like to share a little bit of logistics. We want this to be an interactive experience for everyone. So if you have any questions, things that you want to ask our speakers along the way, please feel free to just speak up. That's the best way, right? Just jump in so we can have a spirited conversation. If you'd rather not do that and you want to use the chat, you can also submit your questions via the chat as well, again, whichever you're more comfortable with. And we also ask that if you are not speaking and not participating in the discussion, to please put yourself on mute, right? So that we minimize the background noise on this call and everyone can have the best learning experience possible. And before we go forward, I'm going to say a few words about my organization. So my name is EJ and I run the Alliance of Angels. We're an angel investing organization that's based here in Seattle. There's 140 angels in my group. Every year we put about 10 million into 20 companies. Most companies that are fundraising from us. Taxes on $40 billion in profit. And let me just, so if you're not on mute, if you are not on mute and you're, we ask that you please put yourself on mute so we don't have any echoes, right? Thank you very much. So, so the Alliance of Angels, a bit about us. So every year we put about 10 million to 20 companies. Most companies that are fundraising from us, they are looking for a total of between $500,000 and 1.5. And our typical check size is 250 to 500, right? And when money comes in from us, it's usually 4 to 6 people, each person putting 25, 50 or 100, and the sum total there is 250 to 500, right? And subsets in terms of our sectors, about half of our investments are in IT, about a quarter in consumer, and the rest are in life sciences, hardware, energy, etc. Right? Our main hard filter here at AFA is that we focus principally on companies that are headquartered in the Pacific Northwest. And in spite of the current public health situation, we've been very active, still as active as we always have been in the past, as the broader market has been. So if you are currently seeking funding, feel free to reach out to me. My email address is at the bottom of this slide. Or if you're an angel investor and you're interested in participating in our organization, feel free to reach out to me as well. I'll be happy to answer any questions that you may have. All right, and with that, I'm going to stop sharing and stop talking. Right, and I'm going to hand the session over to our speakers and our sponsors, Gary and Francisco from K&L Gates.
Awesome. All right, Francisco, I think you're going to share your screen, but while we're getting our slide deck up, I'd just like to say good morning to everybody. Thank you to EJ for giving us an opportunity to chat with folks today. Francisco and I are both members of the Emerging Growth and Venture Capital Practice Group at K&L Gates. I've been with the firm for over 30 years. I joined back in the early 1990s at the outset of the tech boom. So have seen quite a few startups come down the paths over that period. And so we are going to share with you, and hopefully as a conversation and not as a lecture, some observations that Francisco and I have seen with startups over the course of the years, and conversations that we have frequently with founders and people who are looking to commercialize an idea or a concept. And so, Francisco, are you able to get our screen share going here? And So my practice is generally working with a variety of startups. I do a lot of work with angel groups and have been participating with the Alliance of Angels since it started more than 20 years ago. And the National Angel Capital Association has really evolved over the last 10 years or so, which is a group of angel groups across the country that have all come together to share best practices and syndicate deals. And so that's been an excellent organization to advance the whole concept of angel investing and sort of recognize angel capital as an asset class that is really the primary source of funding for first source of funding for most startups these days. And so a lot of our comments and our experience is helping companies get ready for that type of a funding event, as well as the funding events that follow the angel capital, venture, strategic, and then various exit transactions. And so Francisco, maybe you want to say a few words on your background, and then we can jump into the slides.
Yeah, thank you, Gary, and thank you everybody who is joining this presentation. We hope this to be a very informative workshop, and please don't be shy about raising your hand and ask questions, because the more interactive the better. So as Gary, I'm also in the K&L Gates Emerging Growth Practice Group, and I focus my practice on either representing founders and startups in connection with their formation stages and subsequent financings and exits. And we also represent, of course, angels, right, and VC firms in their financing, right? So today, our goal is that you get some basic foundations and tips about how to form a startup and important considerations around that is going to be crucial, especially at the financing stage, right? So the presentation, we divided into 4 segments. First, we'll just give you an overview what we think a startup is or what it means, And then second, we will discuss about choice of entity and the jurisdiction. Then we'll jump into discussion about some startup issues that we usually see in our practice, working with founders and startups, that sometimes it's an issue at the diligence level when investors are going to invest, And finally, even though we are not IP experts, we'll just give you some IP overview tips also to be mindful of, right? So let's get into the first segment, right? And again, please feel free to ask questions at any time. So what's a startup?
Yeah, and so this is primarily sort of definitional and level setting, because obviously startups come in all different shapes and sizes and flavors. But the types of startups that we're talking about, I think, as for this conversation, is generally a group of people, could be 1, could be 3, could be 5, that are coming together to commercialize an opportunity. And it's typically an opportunity that is going to need some type of outside funding at some point, that is going to be needed for growth, scale. Most of the startups that we come in contact with are technology based. There are certainly consumer product companies and other types of companies, but technology is usually sort of running through the theme. And so that's something that we're, as lawyers, and helping the founders make sure that the technology aspects of the business are properly documented at the outset. And that's one of the, the central issues that comes up. The other issues, are surrounding sort of branding and trademark. That's also, always a very, sort of central issue for companies at the outset, because you don't want to start down a path where you're thinking you're going to be, building, market recognition and brand around a particular name, only to find out that someone else has rights to that name and you have to change, after you've, started to develop, an awareness or customer base. And then another sort of series of issues that we often spend a lot of time with is around sort of the employee base and bringing people on and proper equity incentives and the tax aspects associated with all of that. So that's just sort of giving you guys, a feel for the, the types of issues that come up on a regular basis. And, there are always others as well, but these are pretty much involved in almost every startup that we're dealing with. So I'll pause there for a second. Does anyone have any questions or comments that they want to throw out, or other topics that they want to pose to make sure that Francisco and I also address?
And basically, Gary, let me know. When we talk about a startup, especially in the, in the emerging growth space, we are thinking about a company usually, with technology, right, oriented. That is, we expect that it's gonna, we expect some growth, like rapid growth. We are not talking about like, like a small business, like a restaurant or like a food truck, or kind of like a lifestyle business. We are thinking about something different, right?
Yes, that's absolutely right. And then, in addition to technology, the other big bucket of information today is data. And, there's a whole sort of proliferation of, data laws that are coming up both on a state, federal, and countrywide basis. And so that's also another sort of big bucket of topic that we deal with quite a bit with startups. So, all right, so why don't we move on then, Francisco, to
by the way, I cannot see the chat, I think because I'm sharing my screen. So I don't know if there's anything, but I cannot see it.
No chat yet. And that's a good reminder. If anyone wants to put something in the chat, we'll try to monitor that as well. And again, feel free to speak up if you have any questions as we're going through this.
Great. Okay. So, all right. So, imagine you are a founder, you have an idea of a business and you want to create a startup. So the first two questions, that is gonna pop your mind is, okay, well, I need a company, right? Because you don't want to do the business on your own, right? Because then that's not, investors will not invest, in a person, they will invest in a company. So you need a company. So you need a company. And then the question is, what type of company, right? Choice of entity, and where should I incorporate or form the entity, right? So this is what we are going to cover in this segment. In terms of jurisdiction, we'll get into the type of entity in a second, but in terms of jurisdiction, in the venture capital space, Delaware, we would say that is one of the preferred venues for different reasons. It's because it's the mostly used in the startup world. Investors are used to investing in Delaware entities. They know, the law, the state law, and Delaware law is very well developed and provides a lot of protections for directors, and there is like a lot of case law, so there is some certainty in there. So it's not unusual, that especially if you have investors out of state and you have a Washington entity, that they may ask you to convert your entity into a Delaware corporation for purposes of achieving that legal certainty, right? Doesn't mean that Washington entities is a bad choice at all. I mean, we have a lot of clients starting as Washington entities, and investors investing in them, and not without the need of reincorporating in Delaware. But I mean, it's actually pretty common, for out-of-state investors to require that. Right?
Yeah, and I would just add to that, Francisco, that not just venture capital, most investors are preferring Delaware, especially if you're getting investors from different states. So if you've got investors in Washington, California, Oregon, other states, there's a general preference to Delaware. And the reason is not so much that because Delaware law is better than anywhere else. Most other states kind of use the Delaware law as a model for patterning their laws. But the big advantage that Delaware has is they've got this well-developed body of interpreting the statute. So there's case law that inform people of how they have to act in certain situations. And particularly, for example, if you're an investor and you're representing a class, let's say you're a Series C, you're the designee from the Series C class or the Series A round, and you're sitting on the board, you have a fiduciary duty as a director to all the stockholders, but you're representing a particular class of investors. So there's a conflict sometimes that emerges as based on those, two different perspectives. And so Delaware has a very sort of well-developed body of law that tells people, how they have to act in those types of situations. So that's, in a sort of layman's terms, that's, one of the big advantages that Delaware offers.
Yep, and also just a reminder on the other side, if you do incorporate or form your entity in Delaware, but you are doing business in Washington, you will still have to register your Delaware entity in Washington as a foreign entity, right? So then, what happens is that you will have to pay the annual franchise fee in both states. Usually not too much, but that's something to be mindful of, right?
Yeah, and Alan, I see your comment in the chat. I think we just addressed that, and the benefit is not so much the substantive law; it's the interpretation that goes with it, and allows people to understand what their duties are under different situations.
Exactly, because the laws, are very similar. For example, comparing Washington and Delaware, it's very similar.
Yeah, and Kai, I see you had a comment about different types of financing instruments. Let's save that for the Q&A period. We'll circle back to that one.
Yeah. So and then so once you have determined the location, the jurisdiction where you're going to form your startup, then the next question is what type of entity, right? And we basically there are three, right, or two plus one. One is an LLC. The other one is a corporation, and then also you can have an S corporation, right? So LLCs.
And you can have an LLC that elects to be treated as an S corporation.
As an S corporation, that's right. So main differences is, LLC is a pass-through entity, so the LLC itself don't pay taxes, and the members of the LLC are going to be subject to taxation. And then in a corporation, the corporation is the one that paying taxes for the revenue generated, and the shareholders of the corporation will only pay taxes when there is, like even like an issue of dividends or in connection with an exit, right? An S corporation, it's basically a corporation that is treated as an LLC, but we'll get into that for a second, right? So what would you say, Gary? I mean, usually we see corporations are kind of like the preferred vehicle within the venture capital space, right? For different reasons, right? I mean,
there's two primary drivers there. It's one, venture capital funds don't like to invest in pass-through entities because then there's flow-through tax implications that then flow through to the venture capital fund investors, which they seek to avoid. So most venture capital funds, when they're writing term sheets, if the entity is an LLC, they'll include in the term sheet that the LLC has to convert to a C Corp in order to close the transaction. But from a founder's perspective, there's a pretty significant tax incentive that's only available for C Corps right now, that is under section 1202 of the tax code for qualified small business stock, that allows people to basically avoid having to pay any capital gains on up to $10 million of gain. But again, that's only available for C corporations. It's not available for LLCs. So that's been a real motivating factor, whereas in the past we saw, more of a balanced sort of, some startups electing to be LLCs and some electing to be C corps. Since this 1202 qualified small business stock incentive has been in place, it's tipped that balance of that scale a lot more in favor of founders going with C corps from the beginning rather than LLCs. But LLCs are very flexible, offer a lot of advantages, but you can't take advantage of the 1202 opportunity.
Yeah, in terms of, sometimes I get this question, in terms of legal protection, both structures provide the same protection for the members or the shareholders, saying that the entity is going to be responsible for the debts and liabilities of itself, not individually the shareholders, right? Sometimes, I get questions like, oh, wait, but an LLC, I'm responsible for the debts as a member. No, the LLC is going to be responsible, not the members, right?
Yeah.
And then I also, another question that I get often is like, okay, well then I'm gonna do a corporation, and I'm gonna elect to be treated as an S corporation, so I get the best of both worlds, right? Like I get a corporation, and then I also get treated as an LLC. I don't have to pay taxes at the company level, right? So well, that's there are issues around that, right? So S corporations, you can only get individuals as members, as shareholders. So if you're trying to do a round of financing, you can only get funds from individuals, so not like legal entities. And you can only have one class of stock. Right? You can only have basically common. You cannot have preferred stocks, and you can only have also U.S. citizens, as shareholders. So that's also a limitation,
Yeah. And most S corps at some point in their life have something that causes them to violate the S restrictions because there are so many limitations. So it's often a trap, for people who think that they're an S corp, but they've done something to, violate the requirements, and they actually then become taxed as a C corp. So
yeah,
LLCs evolved because of all the limitations in S corps.
Yeah.
So.
Yeah, and finally, just another reminder: a stock issued in an S corp does not qualify for Section 1202 tax exclusion.
Yep,
even if the S corporation is later converted into a corporation, the shares that were issued while the company was an S corp won't qualify, even though the corporation after converts into a from an S-Corp to a corporation. We've seen issues, clients believing that they would qualify, and that ended up being an issue. Right?
Quick question here. Can you have LLCs be treated as C Corps for taxation purposes?
LLCs can elect to be taxed as an S-Corp or be treated as an S-Corp. But then they have to satisfy the S-Corp requirements, meaning you can only have one class of stock.
Okay, but
It,
not
to be elected to, you wouldn't generally want to be taxed as a C Corp because that's imposing a layer of tax that you don't have to pay.
Okay.
Yeah, I've seen in very specific situations where an LLC wants to be elected as a C Corp, which is international entities forming a subsidiary in the U.S., doing it as an LLC, but they don't want the parent company, the foreign parent company be subject to U.S. taxation. So they elect to be treated the LLC in the U.S. as a C Corp, just so they limit their exposure in the U.S. That's the only case I've seen it.
Got it. Is there any limitation for having like foreign co-founders via a C Corp?
No. You can have foreign co-founders in an LLC or a C Corp. No issues. Yeah.
Thank you.
All right.
All right, so next, any other questions? Let's see, we got one in the chat. Can an LLC issue stock? So LLCs issue what are referred to as membership interests or units, which is the equivalent of stock in a corporation. And you can have, preferred units or common units, and you can, structure the distributions exactly the same way that you would structure, the economic interests in a C corporation. They're just called something a little bit different.
Yes, I'm Gary, Brad Chalou here. I have a question in relating to if you can start up a C Corp, but the co-founder uses a virtual office out of Delaware. Have you ever gone across that configuration?
Yeah, there's no, Delaware does not have any requirement that you have a presence actually in the state. So most companies don't have any tie to the state of Delaware other than a registered agent who, is authorized to accept service of process on behalf of the entity. And now there are basically a variety of different services that, can serve as registered agent for startups in the state. So you don't have to actually have any sort of physical location in Delaware.
Sure. But can the founder, would you recommend the founder, if it's a Washington state founder, is there available the option for me to have a virtual office in Delaware, and that way I have no relationship to Washington state at all?
Well, I mean, the main thing is, if you've got employees in the state, then you're going to have to register to do business. If you've got either employees or, a lease or a physical office in the state, that triggers a registration requirement.
Right. Okay,
regardless of whether or not you have a virtual office somewhere else.
Okay. But I'll be dropping you an email, Gary. Thank you.
Yep. Okay. All right. So the next segment is we're going to just talk about some of the issues that come up, when we sit down with founders, and sometimes where people make mistakes. The first group of issues is around the founder equity and structuring the equity properly, because there's some tax implications and some mistakes that you can make that really can't be fixed if you do it incorrectly at the beginning. the most important thing is to try to get all the founder equity documented at the outset when there's basically nominal value of the entity. So when the company is formed, there's basically nominal value before anything gets put into the business, or the company develops any type of technology or intellectual property. That's when you want to make sure the founders get all their equity, because then there's no tax implication to receiving the founders' shares. And so you may have heard there's this tax code section called Section 83B, which allows people to make a tax election on receipt of founders' equity, because absent making an election, the default is that equity in a startup gets taxed as it vests. So on the date that it vests, and it's taxed at the value on the vesting date. And so if, for example, if you issue a big chunk of founder stock and it vests over, say, a 3 or 4 year period, the default rule is, you get taxed every year that it vests based on the value at that point. And hopefully the value is going to be a lot higher, in the out years than it is on the day that you receive it. And so Section 83B allows a founder to make an election to say, rather than the default rule, I want to be taxed at the value on the day it's issued to me. So on the date that it's awarded, even though it's not fully vested and it could be subject to forfeiture, I'm electing to be taxed now. And again, if you're getting everything properly documented at the outset, the value now is going to be nominal. It's usually like, 1/1000th of a penny per share. So, if you get issued 2 million founders shares, you might have $200 worth of income that you would, be taxed on. So that's a tax bill that most people can live with, versus, having 2 million shares that get valued at, $2 or $3 a share down the road when they vest. So that's what this 83B election does. And there's a very narrow window of opportunity when you can do it. It's only 30 days after the date of issuance of the stock. So that's something, as lawyers, Francisco and I, that's like number one on our list, to make sure that we're advising founders of this, and then making sure that these filings get made in the within that 30-day window. And it sometimes requires, making sure you're staying on top, especially if you've got, a number of people in the founders group, making sure everyone signs their documents, gets everything processed in time, and and does that in an orderly manner. So that's a big issue that we focus on. The other thing is, a lot of times people are having conversations with people to try to recruit new people who may or may not be named as founders, but who are going to be sort of early employees, and promising equity awards to people. And so it's very important to make sure that these all get properly documented, both from this tax perspective and also from a perspective that you don't want to have, emails out there that say, okay, you've been promised 5% of the company, which is a very sort of indefinite amount. And so 5%, on the date that email went out, versus 5% when the company gets acquired 2 or 3 years down the road. You don't want someone, coming out of the woodwork saying, oh, I'm entitled to 5% of this company on a sort of undiluted basis because of this email that was, promised to me back when the company was getting organized. So those are things that we often sort of counsel people on, is to make sure you're tying these to, very definite numbers of shares and a cap table that you can look at, that avoids sort of indeterminate promises. Francisco, you want to talk through cap
I
tables?
just wanted to also mention around the 83B election filing is that only, as a reminder, that only applies if the shares are subject to vesting, and the company has the right to repurchase, or there's some kind of like forfeiture feature around the vesting. And also we see like so many instances where founders come to us and say, "Oh, we like to work as a team. We don't need vesting. We're gonna be working together in the future, right?" We try to advise them that it's a good idea to set these milestones, these time milestones, so the founders can earn their shares over time. And if at some point they stop working, then like the unvested shares, get repurchased or cancel, and sometimes like founders don't take that advice, and we have situations where we have maybe a founder owning 50% of a startup that is not doing anything for the business, and that causes issues, of course, in the company, the cap table, and then investors, possibly.
Investors will impose it. If it's not there at the outset, they'll come in and say, okay, as a condition to us giving you the investment, you're going to have to impose vesting. And so it's, our counsel is usually it's better to do that from the outset and get credit, because you might not be taking investment for a year or so down the road. So you might as well get credit for that time versus having the investors come in and say you have to impose vesting, from day one, going forward from the investment. And then, as Francisco said, it's just a fairness issue among founders because, a lot of times, everyone is aligned, but for one reason or another, one member of the group, has to peel off and, decides to do something different. So you don't want that person walking away with, a big chunk of the company. So.
Yeah, that would be a red flag for an investor. Investing in a company like with a founder not doing, with a significant stake in the company and not doing anything.
Yeah.
So,
yep.
All right. Maybe we get into the next one. The other common mistakes.
Yeah. So one of the issues that often comes up is, people are leaving, tech company A to start their startups, and then, there are restrictive covenants. And, the good news is, many states, including Washington, are basically adopting laws that are limiting employers' ability to restrict people to go off and do different things. Washington, as of last year, adopted a new non-compete law that, you're only allowed to impose non-competes on employees earning in excess of $100,000 and some $1,000. And there are other sort of restrictions around that. So it's making it easier for people to leave and go off and do different things, but that's still something you need to focus on and pay attention to and properly document, that you're complying with whatever restrictive covenants you have from your prior employer. And part of that is also, so that's a component of the employment related documents that we put together for startups. And one of those documents is called a PIIA, proprietary information and invention assignment agreement. So what that does is basically say the new employees are basically assigning all of the intellectual property rights to anything that is developed as a result of their work on behalf of the company to the company. And that's a very sort of critical component to make sure that you're having a company that is going to be able to be funded by an outside investor, because if you've got founders that have been working and haven't signed these documents, there's a question, who owns the IP and what does it take later to get back and fix that if it hasn't been done properly at the outset. And particularly if you've had people coming and going on the development team, and you can have some pretty significant uncertainties around that can, we've seen investors will just walk away from a deal because there's too many clouds over the IP ownership. So that's a key sort of building block for any startup.
Yeah, and that's going to be one of the first documents that an investor is going to ask during the legal diligence process. They're going to ask you, tell me, show me your employee census and show me a PIIA agreement executed by each of them, and the founders, of course, because the investors want to make sure that all of the IP generated by founders, employees, and contractors have been properly assigned to the company, because they are invested in the company, right? Not in, so.
Yeah.
Yeah.
Then another big sort of bucket of issues is surrounding the equity structure and making sure, the people who are most important to the business have proper equity incentive to make sure that business succeeds. And that's another focus that the investors have, because, if the CEO and the CTO and the key people in the business don't have the right equity incentives, you're either going to have to pay them significant cash consideration, which most startups don't have the cash to do that to begin with. And, the investors want to make sure that the founders and the people running the business have the same incentive that the investors do to make sure that there's a good outcome for the business. And then another thing that we see is at an exit, a lot of times there'll be a founder who has a big chunk of the stock, sometimes 100%, sometimes, more than 50% of the stock, and the key people don't have that equity. And then they look to try to figure out, when it's approaching a time on an exit, to figure out, how can we compensate these people? And at that point, it gets a lot harder to do that on a tax efficient basis. People can get compensation on an exit, but if you wait too long to put that in place, it's going to be taxed at ordinary income rates versus capital gains rates. So that's why, at the outset and early on, you want to make sure you have the proper equity incentive structure. And so an equity incentive plan, options, restricted stock, and making sure that, the key people have the right allocations of that up front. So that's another big area where we spend a lot of time with startups, trying to make sure that those structures are all put in place. We already talked about the 83B elections. And then another sort of counseling area that we talk about with founders is just to, for founders to understand, that, it's okay to give up a percentage of the business. And in fact, it's oftentimes that's, an outcome that you want to strive for. You don't want to, try to maximize your percentage ownership. What you want to try to maximize is the overall value of the company and the value of your ownership percentage, but not maximizing the percentage ownership. And, there's generally no sort of bright line benefits to maintaining a 51% ownership, because when you have investors that come in and preferred stock rounds and things like that, there will be certain things that the business can't do without a vote on a class basis of those different types of investors. So if you have preferred stock, that the preferred stockholders will have the right to approve an exit as a group. So that's something that we often sort of sit down and counsel people on. And then lastly, the other thing is making sure there's alignment among the founders as to, what are people signing up to, on a long-term basis, and, what is that, making sure everyone's on the same page in terms of, okay, are we really, building this business, to, go through multiple rounds of financing, including maybe venture capital financing, where, we're potentially, giving up, a significant degree of control over this business, in exchange for, building, a business that's going to grow and scale and, maybe become a public company at some point, or, grow to a certain size before there's an exit. And, that's a key differentiator, based on angel investing and angel-backed companies versus venture capital-backed companies, because an exit for an angel-backed company, you can have a very successful exit, at a much lower valuation for an angel-backed company, because you haven't had as much capital that's gone into that business, and the ability to achieve a successful exit can be, much sooner, versus if you bring in venture capital and, raise, 50 or, $100 million of venture capital, you've got to build a much larger business before there's an exit to, achieve the returns that that type of an investor is going to look for. And so, it's important at the outset to make sure that the founders are all in alignment, in terms of what type of business and, what the goals are of everybody.
I had a question. It makes sense that founders need to file the 83B election. Do employees do that as well, or is that even
anyone who has vested stock? Options aren't taxed until the options exercise. So this doesn't apply to stock options. It only applies to stock grants.
Okay. Do you give grants, stock grants to employees as well, or is it?
You can. It gets back to the valuation issue. You have the ability, when the business is formed, to issue stock, and there's, in essence, no value to it, because it's, it's before the business has generated anything of value. Once you have a financing round and there's a valuation on the business, you can't issue stock at that nominal valuation. And so it would be taxed at whatever the valuation of the stock is. It's still relatively low, early on, but there would be a tax that people have to pay. And that's why most companies, once you get past the founding stage, will switch to issuing options instead of stock.
Got it. Thanks.
Yeah, maybe we can go through the QSBS pretty quickly. Also related to the last question, if you hold a stock in a company, then your holding period start ticking, right? For tax purposes. And also that's important if you have C corporation shares for QSBS. QSBS stands for Qualified Small Business Stock, and its regime is contemplated in Section 1202 of the tax code. Basically, what it says is that if you own QSBS shares for a period of at least 5 years, and then the company, subsequently is sold, there is an exit. Pretty much the first $10 million that you get from that exit is tax-free. So
and it also qualifies for an exemption under the Washington state capital gains tax that's going into effect. So.
And then, qualified small business stock, qualified means that it has to be a C corporation, right? So no S-Corps, no LLCs. Small means that the gross assets of the company need to be less than 50 million when the shares were issued. It has to be like a qualified business, there are certain exceptions, like for example, like banking or like certain
services
business or engineering, stuff like that doesn't qualify. And it has to be stock, right? It has to be shares. Doesn't qualify. A note, if you get a convertible note, the holding period start ticking when the note is converted into shares, so it's when you get the shares, basically.
And it has to be originally issued by the company. You can't buy stock from another stockholder.
Yes.
Or another stockholder can't transfer shares.
Yeah.
And that would disqualify it.
Yeah, and I think we went through pretty much all of these issues. This is just like a summary of all of the issues that we have already discussed, like the main questions an investor is gonna check, before they invest, whether the company is in good standing, the cap table is clean, all of the equity shares, stock options have been properly documented and approved by the board, the company has enough authorized shares, and founders are, have vesting schedules and they are like committed to working for the company. All of the IP assigned to the company, right? Does the company have all of the permits it needs for its business? Has the company been doing, like treating employees as contractors or vice versa, right? That's also an issue, and whether the company is also in good standing in filing its taxes. That's kind of like, in a snapshot, the main issues, the main diligence questions that an investor may ask from a legal standpoint.
Yeah, and then so we're getting down to about the last 5 minutes or so. So let's open things up for conversation and questions a little more. There's a bunch of IP issues that branding, trademarks, patents, some of which we touched on our prior comments. Those are all the IP issues, also the data compliance issues. Those could be a separate workshop and have been the subject of a separate workshop. But I guess what we can leave you with is, you want to make sure you're working with a law firm that is focused on the startup community and that understands these different issues that come up at these stages of development. And so, K&L Gates and Francisco and I are in our emerging growth venture capital practice. We offer packages for startups to, put all the documents in place as a comprehensive package for a fixed fee, and have the ability to defer fees until there's a financing event. So you want to find someone, who's flexible, that, can offer, a comprehensive package that, you're then are confident that you have all of these boxes checked. Now, one of the issues Kai raised was around financing instruments. And in particular, we alluded to convertible notes a few times, and a similar instrument is called a SAFE, which is a simple agreement for future equity, which operates just like a convertible note in that the investor gives the company some money now, and then that money, that instrument will convert into equity at a later point when the company does what's called a priced round, where you actually have a valuation set on the business. And safes and convertible notes allow companies to raise money without formalizing a valuation, and then you can put that money to use to hopefully build the valuation of the company, to a higher level before you have to actually sell a priced round of equity. Convertible notes are nice from an investor's perspective because you get a lot more rights and it's a lot more defined. There's interest, there's a maturity date. From a company's perspective and a founder's perspective, safes are a lot better because it avoids, any sort of ticking time bomb out there that if you don't have your priced equity round by a certain date, you don't have to then go back and renegotiate a deal with your earlier investors. You have a lot more flexibility. So safes, I think, they were invented down in the Bay Area. Y Combinator, which is an accelerator down there, came up with them, and they're fairly widely used down there, but less so in Seattle and other markets. But I think they're becoming more prevalent now. One of the issues with convertible notes that a lot of people don't realize is, there's accrued interest on these things. And so while they're outstanding, the companies are supposed to be issuing 1099s for accrued interest over the course of the year. So on an annual basis, you're actually getting taxable income, from an investor's perspective, and from a company perspective, you're, supposed to report, this income to the investors, but a lot of times, companies aren't doing that. So any questions that people want to raise? I'm just looking through the chats here. Let's see, there's a question around entertainment companies. I don't, we've worked with some different production companies, but I don't necessarily see them, in any sort of significantly different category than other startups. Francisco, any other points you'd like to make?
There was a question there, I think I saw from Daniel. I had a patent for putting a 5G router on porch lights. Oh no, a router on my porch light. I've worked for T-Mobile.
Yeah, I think that's kind of a personal question that we
Yeah.
can't really answer in this context here.
Yeah.
Yeah, and we also represent T-Mobile.
Best.
I had a question about early stages of C Corp. So if I filed all the paperwork, founded a single member C Corp, and suppose I'm going to leave my full-time job in a couple of weeks, and we have until the end of the year. And so basically my question is, do I need to pay myself a salary for this short period if the company is not making any revenue? Maybe there's no product yet.
No.
Can I live off my savings?
No, I mean, and that's a function of sort of the state labor and employment laws. Once you start employing sort of non-management people, they're subject to the minimum wage requirements. So, a lot of startups aren't paying, significant cash salaries and instead using equity to, compensate and attract employees. Those folks are still subject to the minimum wage requirements. So that's an issue that comes up, with some degree of regularity. But as a founder, you don't have to pay yourself that minimum wage.
Oh, do I have to pay myself anything in the first? Is there like a certain period at which point you have to start paying yourself
No.
with the C Corp?
I mean, you would be an exempt employee.
Okay.
Yeah, I think we are not employment attorneys, but I think there is an exemption for what is called exempt executive employees, where you don't need to, you are not subject to the minimum wages, and founders may qualify under that, But then, of course, that's different. If you hire employees, actual employees, then that's a different story. Yeah.
So while you're this exempt employee, do you need to set up, get registered like in the state of Washington as an employer and everything, even if you're not paying salaries?
No, you don't have to register. Well, you don't have to register with the Department of Labor or qualify the business until there are basically, employees that are required to be paid under the wage and hour requirements, or you enter into a lease and have a physical presence in the state. So there's a little bit of leeway before you have to register.
Got it.
Right. Hey, thank you. I think we're actually all out of time. And then thanks for everyone for all the questions and for participating. And of course, thanks very much to Gary and Francisco for sharing all the knowledge analysis on the subject today. I'm sure if you have any questions, you can follow up with them. Hey, Gary, you have your email. You want to send your email out onto the group chat. So if folks have any questions, feel free to follow up either Gary or Francisco for additional questions. And if you have signed up on the Eventbrite, we'll be sending out the slides to everyone. All right. And so with that, I'd like to thank everyone for participating. Thank Gary and Francisco, and we wish everyone to have a great rest of the week.
Great. Thanks, everyone.
Right.
Thank you.
Thank you.
Thanks. Goodbye.
Bye-bye.